Okay, for those of you who are just joining us again, who have just joined us, my name is Timothy Chambade, and I'll be taking you through today's Zoom. The topic for today's learning is an introduction to indicators. So what are we going to cover today? First of all, we're going to define what indicators are, okay? And then we shall look at the different types of indicators, and there are two types. Then we shall look at examples of these indicators. And finally, we shall try and determine what the best indicators to use are. Okay, so what are indicators, guys? Indicators are simply formulas or methods that we can use to predict where the markets are going to move to next. Remember, in our trading, what we're trying to do is to predict if the market is going to go up. That means the bulls are going to be in control, or if the market is going to go down, meaning the bears are in control. That is what we're trying to ascertain every time we're looking at our trying to place trades, or before we place any trades. We'd like to predict where the markets are going to move to next, and then we'd like to move in the same direction as the markets. So indicators are basically just formulas that help us to predict where the markets are going to move to next. Okay, so what are the different types of indicators? So there are two types of indicators, guys. There are leading indicators and there are lagging indicators. And just like their names are, leading indicators help us to predict the future, or they help us to anticipate what's coming next. They are leading. Of course, there really can't be anything that leads price action, because nobody knows how the price is going to behave. But there are tools, or there are indicators that we can use to sort of see in front of where price is going to be. If we were to take an analogy of a car, okay, the leading indicators would be what we would see in our front windscreen as we're driving, something that can warn us ahead, maybe a sign we can see ahead, and anticipate. Using that sign, we can anticipate probably how the road is going to be. Are we approaching a hill? Are we approaching a hill? Are we going to go down or up? So leading indicators help us predict the future, or they help us to anticipate what's coming ahead. Okay. The second type, basically, they give us a signal before a new trend or reversal occurs. Guys, for those of you who are traders, and for those of you who are new, the best thing that can happen to you as a trader is to catch a new trend at its beginning, just when it's beginning to form, and to ride it all the way to the end, to the time it ends, or to its completion. Because in so doing, you'll get the most number of pips, and the pips will equal to profit. So all of us in our journey as traders, we're trying to squeeze the most out of what we can in any particular trend, or in any particular market move. So the leading indicators give us a signal before the new trend occurs, or before a reversal occurs. Lagging indicators, on the other hand, give us a signal after the trend has started. And basically, they're just confirming that the trend has actually formed. Okay, so all types of indicators that we have in our Forex charts, they are either going to be leading or they are going to be lagging. All of them can be classified as one or the other. Of course, most of the ones that we have, or most of the ones, the common ones, are lagging indicators. So let's look at examples of these indicators. Okay, and let's start by looking at examples of what we refer to as the leading indicators. And after we go through these slides, I will show you practically on the charts how we apply these indicators. Remember, this is an interactive class, so at any point in time, please interrupt, put your hand up, or type in the chat your question, and we shall be glad to answer it. So the common types of leading indicators, we have the pivot points or levels. There is a strategy that revolves around the pivot levels. And for those of you who are already traders, if you do not know how to use the pivot levels, please research about them. These are very powerful in intraday trading, especially for intraday traders. They are very powerful. Okay, and these are generally just levels that are calculated based purely on price action and swing high and swing lows of the previous day's candlesticks. Okay, and then they'll give us some sort of support or resistance lines that we use to anticipate how price will behave. So that is why they're called leading indicators. We also have, similar to the pivot levels, we have the Fibonacci. We shall be covering the Fibonacci in 2 weeks' time. So please don't miss that class, but the Fibonacci extension and retracements can be used as leading indicators as well to anticipate the beginning or the end of price moves. Okay, we have trading volume, the amount of volume in the market at a time. We shall show you how to use the trading volume, and also look out for other indicators. There are very many indicators out there that incorporate trading volume in their analysis. But lastly, another example of the leading indicators is the trend lines, or the support and resistance lines. And you will see that all these leading indicators are similar in a certain way. For those of you who are already traders, they have a similarity to them. The second type of indicators, the lagging indicators, examples of the lagging indicators. And the lagging indicators, remember, are trend following or momentum following indicators. Here we have the oscillators, the things like the RSI, stochastic, parabolic, and the parabolic SAR. We shall be looking at all these in our following lessons next week on Tuesday and Thursday. We have the moving averages, the EMAs and the SMAs. EMA, exponential moving average, and SMA is a simple moving average. We have the Bollinger Bands, and we have the MACD. These are just examples. There are very many more types of indicators out there, both lagging indicators especially. So the million-dollar question then is, what is the best indicator to use? And I know many of us as traders struggle with this. What is the best indicator to use? And the correct answer is that there is no best indicator, because that indicator, which is the Holy Grail, does not exist. There is no indicator that is 100% going to give you a perfect signal each and every day, each and every time. It doesn't matter what lie they tell you. There is no 100% indicator. Okay? And why is that? If you're using leading indicators, they will help you to catch trend reversals early. So usually, if you get in early with a leading indicator, you will lock in profits easily and quickly, and you ride the trend for longer. So many of us like leading indicators for that reason. However, these same leading indicators have so many fake outs or false breakouts. Remember, with the leading indicators, you're trying to catch a trend reversal. So sometimes you think the trend has actually started reversing, yet it is actually in continuation. So those are what we call the fake outs. Okay, so that is the disadvantage of the leading indicators. So there's no leading indicator that's going to be 100% accurate. It will always, once in a while, give you fake outs. Okay, and leading indicators are very notorious for this, the fake outs. However, because the leading indicators are using price action, they usually have very tight stops. So if you use good risk management, it's easy to manage your loss with the leading indicators. As much as you may have many small losses, when you actually do get a good reversal signal, you're going to ride it for long, and you get, that's the situations where you see people getting 10-hour risk reward, 5-hour. It's because they're using the leading indicators and they're getting in early on these trend reversals. That's the disadvantage of leading indicators. The lagging indicators, on the other hand, much as usually, by the time you get in, you're sure the trend has started. Usually you're late, you're a little late in entering. So it's very easy to get in with a lagging indicator, and shortly after you get in, the price goes back up. Or maybe you get in at the bottom of the trend when the trend is exhausted. So often the biggest gains of the trend occur in the first few bars. And that is why the people of the leading indicators, if they are right, will get these, will get more profits. So by using the lagging indicator, potentially you're missing out on much of the profit. So what do we do? The best strategies combine leading and lagging indicators. So as you develop your trading strategies, guys, the best thing you can do is to have a mixture of both the leading indicators, as we've seen them. We've seen the pivot levels, the Fibonacci, the trading volume, the trend lines, as well as the price action candlesticks themselves are also leading indicators. And then you combine those with the lagging indicators. You combine them with the oscillators, the RSI, stochastic, parabolic SI. You combine them with the EMAs. You combine them with the Bollinger Bands and the MACD. Okay, so let's just look at an example of how you can do this. Okay, and in our first example, we're going to imagine we're building a trading strategy. Okay, we know that there is no one good indicator that's the magic grail, so we're going to try and combine both leading and lagging. So in order to determine our trend, okay, we're going to use a lagging indicator, which is an SMA. And for those of you who have been in our analysis Zooms where we've looked at the strong weak analysis, we do utilize this in our strategy. Here, your instructors, myself inclusive, and if you've not seen our tool, we have a tool that can help you do analysis and help you to determine 16 pairs to trade for the week. Those of you who have been with us, we've used this tool, and this week alone, it has given us a lot of profits. So part of our strategy, we use a lagging indicator, which is the 200 SMA, simple moving average. And we use this to ascertain which currencies are strong and which are weak, and we match them together. For those of you who might have missed the teachings on this indicator, if you visit our YouTube channel, you can go and watch how you can use the 200 period simple moving average to help you to generate trading pairs for the week, or biases for certain particular trading pairs for the week. Okay, so in one strategy you can do that to get context. Now, when you've gotten the context in which you're going to trade, for example, this week we've been selling the Australian dollar, US dollar. We've been selling the New Zealand dollar, US dollar. Okay, so now you know you're looking for a bearish signal because of the trend, which you've determined with the lagging indicator. You now move to a leading indicator, which in this case could be a price action candlestick, or it could be a pivot point or trend line. And then you look to get in on the price action in the direction of the trend that has been given to you by the lagging indicator. So when you combine these two leading and lagging indicators, you then have a proper trading strategy, or a more solid trading strategy. Okay. Now remember also that as we use these indicators, we're looking for confluence. Confluence means when one or two or three indicators is telling you to do the same thing. Okay, so already we've ascertained that we're going to sell the Australian dollar, US dollar based on our lagging indicator. And then now our leading indicator comes in on a smaller time frame usually than the one we've used on the lagging indicator. And it's also confirming that now it's time to sell. Usually you will get in and ride and get good profits. In a strategy like this, the leading indicators will also help us to put stops and also know when to take profits. And this is especially very good with the pivot points or pivot lines. It's also very good with the Fibonacci extensions and retracements. They are usually very good points for you to know when you should take your profits, where you should put your stop losses. So the leading indicator is also very good at this. Remember, as we're trading, the outcome or the output we want is for whatever we're analyzing. Before we make our decision, we want to know, first of all, when to enter the trade. Secondly, in case the trade goes against us, how do we manage it? Where do we exit? How do you know that now I was wrong? Get out and get out quickly without taking a very big hit. And thirdly, if I'm right, at which point do I get out so I don't cut my losses short and I can let my profits run? Again, the leading indicators can help us to do this. Remember, guys, we're going to be looking at some of these strategies in more detail in the coming weeks. The whole of next week, we're going to be looking at indicators and indicator trading strategies that we can incorporate and use to be profitable in our trading. We shall introduce the indicators one by one and then show you how to combine them to get solid trading entries, to get solid stop losses that minimize loss, stop losses that minimize that protect your capital, and to also get good take profit points that help you to maximize your good runs. So in one strategy, for example, you can combine the leading indicators. Sorry, you start by the lagging indicator, the 200 SMA on a higher time frame. It confirms for you a trend or a context in which you're going to trade. Usually we do this on a higher time frame. For example, we've been doing this on the 4-hourly. For those of you who have missed out on this, you check up our YouTube channel and you will see those videos where we're using the strong weak analysis to determine our 16 currency pairs for the week and to get a bias. And then after we have that, it now generates for us trade recommendations, and then now we go into a lower time frame. And in the lower time frame, we don't use the lagging indicators. We're now looking at the leading indicators to help us to get good entries, to help us know where to put our stops, and to help us know where to take our profits from. Let's look at another example. Example 2. After a massive downtrend, we anticipate that there is going to be a retracement, not a reversal, but a retracement. Okay. So we draw our Fibonacci, giving us the Fibonacci retracements. Okay. And then at the retracement zones, we watch out, or we use the oscillator to tell us when the market is exhausted, or we look out for divergence of the oscillator together with the price action. And this can then help us to know that the retracement is exhausted and we're now going to go back in the direction of the trend. And again, we shall be looking at this in real practical sense when we are looking at the Fibonacci, because I cannot use the Fibonacci now and we exhaust it. But we shall be looking at the Fibonacci and how we can combine it with the oscillators to know when we can now take good entry signals. And remember, the Fibonacci being a leading indicator, it will help us with our stop loss, it will help us with our take profit. And it will help us, of course, at the time of pulling the trigger to enter the trade. Okay. So what have we looked at today? Very quickly. We've defined the indicators, okay? Indicators are simply formulas that help us to predict where the market is going to move to. Remember, if we know where the market is going to move to, we move with it in that same direction and we profit from that move. So that is why we use, or we need indicators in our trading to help us to predict where the market is going to go to next. Okay, we've seen that there are two types of indicators, the leading indicators and the lagging indicators. The leading indicators, if it's an analogy of a moving car, if we're the drivers, the leading indicators will be our front windscreen, and the lagging indicators will be our rear view mirror, which is at the top here. Okay, the rear view mirror, we see what has happened. We confirm what has happened. The windscreen, we see where we're going. So if we combine the two, we're safe on the road, relatively safe. Of course, accidents happen every now and then, but relatively, you cannot drive properly without the rear view mirror and the front windscreen if it's not clear. Okay, we've seen the advantages of each type of indicator. We've seen that the leading indicators help us to get in early on the new trends and ride them longer. However, sometimes they are fake outs. And for the lagging indicators, we've seen that they confirm for us that the trend is actually there. However, their disadvantage is that they're usually late, or by the time they give us the signal, a lot of the move has already happened that we could have profited from. So each type of indicator has its advantages and disadvantages. Okay. So next, we've seen how we can combine the leading and lagging indicators, and we shall look at this a bit practically. But we've said that both need to be used together in tandem to give us good trading strategies for best results. So in conclusion, we're just going to say that there is no one single indicator, or there's no combination of indicators that is 100% accurate at predicting the market or where the market is going to move to next. Yes, we use indicators to help us to make decisions, but there's no strategy out there, because if it was out there, everyone would have it and it wouldn't even be working anymore because everyone would have it. So there's nothing that's 100% accurate. Yes, there are good strategies that give you 80% return, even up to 95%, but there's none that is 100% that will hit it every single time. So as you employ or as you build your trading strategies, please have that at the back of your mind. That in my strategy might be good, yes, but it will never be accurate 100% of the time. So nobody should ever lie you that they've got the magic trail indicator, blah, 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 blah. Guys have been in trading, who have been working on my trading journey now, coming 10 years, over 10 years. I even forget the exact date, but I have never seen that magic indicator. Always, they all have their shortcomings. Yes, some of them are actually very good indicators, but they all have their shortcomings. So that said, we need to note that to complete our trade strategy, we're building a trade strategy. We combine our leading, lagging indicators, and then we incorporate good trade and money management. That's what makes a trading strategy complete and profitable in the long run. We manage the trades that will go bad because there's no strategy that's 100%, and we let the trades that are good run and give us as much profit as they can. Because we know there is no strategy that's 100%, there's no indicator that will always be right all the time. We make sure we incorporate good money management at all times. So that said, I'm going to take questions. We're going to introduce a few of the indicators. You can ask questions on any indicator, but just know that in the coming weeks, we are going to dive now deeper into each particular indicator. We're going to pick out the common ones and give you also strategies that you can use or that you can incorporate in some of your trading strategies that you already have. And remember, as we do this, we shall build in also the money management aspect, the trade and risk reward, the risk aspect, so that you build complete or you become complete traders. With this, you will be profitable in the long run.